Welcome, ladies and gentlemen. Today is July 10th. I'm doing this special video today because I believe the U.S. and global markets are awaiting a major contagion capitulation event that may be centered around global market crisis. I'm going to show you some things today, and I want you to be aware that if you are not preparing for this move, and if you are following what appears to be the bulk of global traders, just essentially buying the dip and playing the same old game plan, then you need to really rethink your game plan going forward. The title of this is H2 2022 Capitulation Crisis for U.S. and Global Markets is Pending. Why U.S. global traders are running the same playbook, buying the dip, and why this time inflation, credit, debt concerns will play a bigger role in the outcome. Current stage, markets are waiting on capitulation, then markets will enter a new phase and move very, very quickly. Let's go ahead and get started. I want to show you first this chart. This is a chart of a custom volume ratio that I've been using for a few weeks here with the S&P down here below, the SPY. You can see we saw a broad capitulation shift right here near the top of the markets. And since then, we've seen a number of buying the dip opportunities here. Traders are doing what they believe is the right move, which is trying to buy into these lows in U.S. assets. This is a volume of the NYSE. So understand that traders are doing what they've always been doing. Buying here into the dip in 2018, buying here into the dip in 2019, buying here initially into the lows around March 2020, and again buying here through COVID as it continued to rally up, moderately buying into this section here. You can see the lower peaks here. Then we started aggressively buying into this late cycle, May, June, July here, where we saw more buying into the move. Now we're seeing a big amount of volume buying into this current dip. We are getting divergence here, but I'm suspecting that some contagion event, some crisis event is going to change this, is going to come somehow over the next 2 or 3 months, likely some inflationary catalyst, which is going to potentially move multiple foreign nations into crisis, creating a humanitarian crisis and a financial crisis at the same time. But I believe we're setting up for a very big contagion event, much bigger than this, could very much disrupt the markets. So pay attention here. Traders are essentially buying the dip. They're expecting the U.S. Fed to save the day. Now, next chart I want to highlight is this. What could go wrong? Delinquency rates on single-family mortgages is the blue line. It is staying very, very low right now. A net percentage of domestic banks tightening credit standards. We've seen a very big increase in U.S. banks tightening credit standards, the highest increase we've seen since the COVID crisis or the 2007-8 crisis, just before the markets entered into a recession. Now, we haven't turned positive on this number yet, but again, this number only reflects to Q1, the very beginning of 2022. We actually can assume that these numbers are way up here, possibly up in the 20 to 40% range, with banks now tightening, the Fed now raising aggressively, which could put us very, very quickly into a deep recession. Let me try to reorganize this. So understand that we're now very likely up into this area, already into recession in the midst of a very high inflationary cycle. And I want you to understand that traders are not paying attention to this. They're really not looking at the fact that we're seeing massive global tightening on a scale with more money than ever floating around the global system. We are likely way up in this area right now, and we're now starting to see foreclosures of single-family mortgages and delinquency rates really start to climb. Now, next, we are going to highlight let me find it, this one. This is the trade balance current inflation and M2 money stock. You can see here that when we had the 2008 collapse and the 2000 collapse, we had a collapse in trade balance. This is actually an inverted trade balance. So this is showing you that trade balances are going negative, 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 bigger and bigger. This is a reversion back to a slowing down of the economy. You can see here that this shows we've seen a very big slowdown in the economy in Q1 2022, and we're likely to see a bigger drop down here. You can see here we've got the inflation is trending. Remember, this is just not updated into 2022 yet. This is probably way up here in the 8%, 6.5% to 8% range. We know that from inflationary trends that are coming right now. And money stock is M2 money stock is updated as of 2022. I'm expecting to see a very big collapse in money stock over the next 6 to 12 months, which could present a very big collapse in the U.S. market. So remember, we have seen inflation stay low, very, very low, extremely low down in this area in the 1 and 2 range. Now inflation is up here around 6, 7, 8 and likely to go a bit higher. This is U.S. Money stock is likely to collapse. Trade balance is likely to collapse. And that puts us pretty much right here, right over in this area, in the same as 2008, 2009. This time it's going to be global, though. It's not going to be U.S.-led with the housing market collapse, although U.S. housing will probably move dramatically downward. We are going to see some real issues in the global markets that are going to really stress the U.S., NATO, IMF, and others. So be prepared. We're at a very fractured world right now financially. Okay, next we are going to highlight my volatility index, custom volatility index. This is something I use to measure directionary trends. You can see here we're going through 2018 with the dip in early February, recovered back up above 12, 10, 11, 12, which is a good bullish ratio. Then we had the late 2018 dip when the Fed tried to raise interest rates to 2.5%, caused the markets to collapse, came back down to this capitulation level, rallied back out of it, got above 8, 9, 10, really had a pretty strong rally trend, higher highs, higher lows, moving higher, got back up here to 10, 11, 12, 14. Then we had some rotation in here, still bullish, still above 8, 9, 10. That's what I'm looking for general bullish trending. Then we had COVID, and this COVID broke down, moved immediately into capitulation lows below 6.5 and 7. This was an immediate capitulation bottom setting up, extended bottom setting up, and when it finally bottomed over here, it gave us a very strong indication that selling was over. We were still in bearish trending. We started to move above bullish trending back over here when we got above 6 and 7. At this point, we had a little bit of rotation here during the election period, and then we were off to the races, which saw really high numbers, 15, 16, 17, almost 18 up here. Now, since basically end of 2021, we've seen this trend change. We've seen lower lows, higher highs, extreme volatility through the end of the year, finally broke down in November of 2021, and now we've seen these lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Now we've got a lower high over here. I'm expecting this to consolidate and congest this week. Earnings are going to come out. I think we're going to be a little surprised with earnings and forward guidance. I think it's going to cause the markets to likely collapse back down into this 456 level, and I think this could be the beginning of a broader contagion event that traders are not prepared for. Traders right now have seen this as buy the dip, buy the dip, buy the dip, because they've been attuned to buying the dip throughout the years. The Fed has managed everything fairly efficiently. But remember, the Fed has managed everything in a in a moderate inflationary trend. So understand this 2018-19 time frame, which is right over here, inflation has been 1-2% on average. It has not been anything serious. Now we're talking 7, 8, 9, 10% in some cases. In some countries, It's well over 100%. One country, I think it's Zimbabwe, is over 200%. This inflationary trend, unless the markets break by the end of this year, is going to put some severe pressure on what the Fed is going to be capable of doing and whether or not this buy the dip actually plays out. The Fed is likely to want to try to move rates aggressively higher, and that means that we're looking at another 0.75% to maybe 1% move higher in the Fed, trying to stomp out inflationary trends globally. And I'm not even sure that's going to be enough. We might have to see interest rates up around 10 or 12% for mortgages, and that would put the Fed funds rate somewhere around 6.5%, 7.5%, probably a little higher. Okay, next, we are going to highlight the U.S. market strength. U.S. dollar is doing extremely well, and I believe it's going to continue to hold up fairly well. But when it breaks, ladies and gentlemen, look out. It could be a very disastrous global market trend. The reason why the U.S. dollar is holding up so well is foreign markets are under a lot of pressure, foreign currencies are under a lot of pressure, and we're seeing a very big decline in currency valuation and economic activity throughout the world right now. So this is showing us that the U.S. markets and the U.S. dollar are holding up much better than the foreign markets. Foreign markets are already moving towards COVID lows over here. This is the COVID low area. I expect foreign markets to break downward over the next 2 or 3 months and retest these COVID lows fairly quickly. U.S. markets may benefit from a shifting capital stance where foreign capital may be moving into U.S. markets while the dollar is strong, maybe still moving downward, but not as aggressively as foreign markets. And this gives us an opportunity to maybe try to ride some things out. Your best bet is to hedge effectively right now in cash, metals, and potentially bonds. I think that everything is going to start unwinding over the next 6 to 12 months, and we'll see how the global markets really react to this. It may end up being the end of certain currencies or an extended restructuring, possibly backed by the IMF and the U.S. For many, many countries, kind of like what happened to Greece many years ago. So understand, the U.S. markets right now are holding up very strong. Dollar's holding up very strong. This may hold up a bit stronger, but I don't see any real uptrend out of this move. Eventually, I see it just weaning lower, but not as aggressively as foreign markets. But once this changes, look out, ladies and gentlemen. The bottom is likely to fall out, and that's what I'm calling capitulation. Okay, next we are going to highlight the Bradley Custom U.S. Devaluation Trend Index. This is a chart of what I call real valuation of U.S. stocks going forward. You can see here that we've got an extended rotation in trend right here. We've come back down to this consolidation, what I call inflection point. This was the 2018 bottom. This changed sentiment in the market from 2016 when we had the elections into 2017. The U.S. market actually started to take off. In 2018, we had a change in direction. This was the bottom that occurred in early 2018. This was the shifting of valuations and trend, capital. This basically is the Fed supporting the market. This created the rally phase through COVID, the consolidation through the peak of COVID. This was the big trend after COVID. You can see we rolled over in early 2021. This was showing you that valuations shifted direction. Then we had a bit of a reprieve from 2021 all the way through the middle of the year, eventually rolling over in October, November 2021, and now we're in a decidedly downward trend. So understand that this is weakening market trend. That's what this is showing you. Weakening market trend and valuation overall. Weakening market trend through this period. Strengthening market trend. This is telling us that we have opportunity for big upward trending as we move forward. This is telling us that we have very little opportunity in upward price movement, so we shouldn't be looking to buy anything except potentially defensive consumer staple products. For example, beverages, paper products, toilet paper, paper towels, those types of things, essential food items, essential essential consumer items will still be purchased. Other extras, not so much. Luxury goods probably going to be weaning off or waning off here recently. So this tells us that we're looking at a bit of a reprieve here. We've come back up over the last 3 or 4 weeks trying to find a bottom. I'm expecting this to break downward. I'm expecting the next 3 weeks of earnings to really rattle investors, put them into more realistic time frames, saying, hey, we're not out of the woods yet, and the Fed is likely going to have to move at least a 0.5 percentage point to 0.75 percentage point to try to move higher, to stave off inflation. Okay, now, lastly, I want to highlight this. This is showing you that my long-term systems are still bullish, and shorter-term systems are mixed, moderate, bearish. My allocation levels are 10% into stocks because my long-term systems are still bullish. 45% cash, 25% metals, which are marking as really bullish long-term. And bonds I have set up here as 20%. Just move this up a little bit because I believe U.S. bonds could turn into a real solid safe haven. Risks are all over the place. And what I'm calling the Reagan trap, which is the Fed inadvertently keeping rates so low for so long, causing foreign markets to gorge themselves on credit and debt. And now that the Fed is trapped behind this inflation bubble, which is partly because of global markets as well, partly because of how COVID was handled, we are now in an area where the Fed must attempt to burst inflationary trends. And in order to do that, the Fed may have to raise rates excessively, possibly to levels we haven't seen since 1982, 83, 84, maybe even higher. That means that you're going to see a real change in valuation over the next 10 or 20 months, 2 years roughly, and we're going to see how the Fed is able to do this. It may disrupt foreign markets. My concerns are Asia, South America, Eastern Europe, and others. For example, Africa possibly as well, particularly the North Gold Coast of Africa. So understand that we have a very broad concern right now. I am moving, suggesting that clients stay mostly in cash, small amount of stocks, and properly hedging against risks going forward. Okay, so now I'm going to show you here the long-term setup. So this is real estate. This is IYR. This is weekly on the top, daily on the bottom. Let me try to move this down a little bit. You can see real estate is still bullish. I believe it's going to fall, but we haven't seen it move into bearish trending yet. Daily basis, we've moved into bearish trending back here in May. So understand that this is a long-term bullish, risk on, short-term bearish, risk off. I wouldn't be trying to buy this bottom yet. We don't have any confirmation that a bullish opportunity in the market is setting up. With regards to the transportation index, we have long-term bullish, still pink, which is moderate bullish, short-term bearish. You can see we went bearish right here on April 6th. So again, transportation index short-term is showing us a contraction in the economy as expected. Long-term risk is still on. Traders are still buying this dip, thinking that the Fed is going to come in and navigate a safe, soft landing, and I'm warning you that things could get really crazy over the next 6 months. Let's take a look at IWM, which is the Russell 2000. You can see that we have gone into bearish trending here on the weekly, so this is risk off with regards to the Russell 2000. Both weekly and daily are bearish. This means that there is real concern in the Russell 2000 right now. There is no upward movement. Everything is bearish. We should be staying away from the Russell 2000 for looking for any buying opportunities right now. We have no confirmation, long-term or short-term, that the market is going to move higher. SPY, we have long-term bullish, short-term bearish. We went bearish on April 26th. Again, long-term risk is still on. Traders are trying to buy this dip. Short-term, traders should be bearish, should not be trying to buy this dip short-term. Yeah, there's going to be some little bounces here, but we don't have any confirmation of an uptrend yet, as I've shown you. Financial sector, U.S. banks holding up actually pretty well. Long-term bullish, still pink. Short-term bearish, went bearish on April 29th. Again, same setup. This could turn really ugly for the U.S. banking sector if foreclosures, consumers, and global markets start to really contract. So be prepared. We could see a very big breakdown back here around the $15, $18 level, COVID lows, which would be about a 62% drop in the financial sector if my expectations come true. E-mini futures are bullish, holding up green, risk on. Daily, risk off. We went bearish right here on this red arrow, April 26th. So long-term risk is on, short-term risk is off. This means that traders are attempting to, again, buy the dip, ride this out as the Fed navigates a soft landing. I'm warning you to be very, very cautious. I think the next 3 to 6 months could be extremely dangerous with a lot of volatility, a real potential for a black swan event, okay? Lastly, the NASDAQ. NASDAQ went bearish a couple weeks ago. You can see here, we're getting into this yellow trending here, which is neutral bearish, okay? Could change direction, could get a bit of a pop. It is already bearish from back over here, which is, I get my mouse to cooperate, roughly April 7th, somewhere around there, April 4th, April 8th. So we're long-term bearish, risk off. Short-term bearish, risk off. NASDAQ may come under some severe pressure, really kind of an extended dot-com bubble burst with regards to valuations. Everybody's heard about Elon Musk pulling out of the Twitter deal, kind of similar to what happened in the 1999-2000 dot-com bubble burst. Valuations were just all over the place, 4, 5, 10 times what real valuations were, and I think this is a combination, this current setup is a very unique combination of excessive valuations over the last 4 or 5 years, moderate inflation, easy money policies by the Fed and global central banks pushing everyone into extreme debt and credit, and now with inflation shooting through the roof and the Fed trying to stave off inflation, I see it as a kind of a 1-2-3 punch. We're going to see a decreased valuation, increased Fed funds rate, destroying capital and credit markets, potentially in the process. And I don't see any way that at-risk, severe at-risk nations, we're already seeing it in Sri Lanka, Zimbabwe, areas of Europe, Turkey is next on the list. I mean, it's going to get really wonky over the next 5 or 6 months. So you need to be aware of the fact that currencies could see a big shift. So now I'm going to stop here, 2008, and what you can see here is this is a measurement of US dollar index in blue, UUP, and then these are custom indexes that I have related to orange is the Asian market and yellow is the European market. And you can see here that Asian market has continued to weaken since 2012. To the US dollar. This is dollar strength overall. This is Asian market weakness overall, and it is continuing to weaken. As you can see here, this is the European market, and you can see the European market is weakening to new highs. This is the US dollar. The US dollar here is actually, and this is in comparison, this is just the UUP. This is the dollar strengthening against foreign markets. So we're seeing what's happening here is we're seeing these global market trends really start to weaken against the dollar. And I wanted to highlight that here. If I can drag this over. This is FinViz. See if I can do this. So you can see here, here's the European to US dollar, GBP US dollar JPY. So this is the dollar strengthening against the JPY. This is the British pound weakening against the US dollar. Here's the euro dollar weakening against the US dollar. Here's the US dollar to Canadian dollar, which is actually kind of flat over the last 12 months. It has reached a 1.20 level. Now it looks like the U.S. dollar is actually strengthening against the Canadian dollar slightly from 1.2 to 1.25. Euro dollar to Swiss franc strengthening. U.S. dollar is strengthening. Australian dollar to U.S. dollar. Australian dollar is weakening compared to U.S. dollar. New Zealand dollar to U.S. dollar is weakening quite excessively by more than about 10.5%, 11%. Euro to British pound is weakening since 2011. British pound to JPY, British pound is actually strengthening compared to Japanese yen. Yen is weakening. And of course, Bitcoin here has collapsed from, nearly 70,000 to 20,000. And I think the target down here is about 9,500. So what's happening is these currencies really are starting to get kind of ugly in regard to comparison to the US dollar. These top three charts say everything. Euro dollar to US dollar has collapsed from 1.25 to 1.0. That's about a 25% collapse. British pound has collapsed from 1.4 to 1.2. That's again about a 22% collapse, if my numbers are correct. 18 to 22% collapse. Japanese yen dollar has moved from 1.05 to 1.36. That's about I'm going to guess about a 28 to 30% collapse. The strength of the dollar is still at play. And what's happening with the strength of the dollar is that we are seeing the dollar really strengthen at levels we have not seen at any time really in the past when you actually look at this. The dollar could continue to strengthen for the next 2 or 3 months, reaching an apex where it becomes the primary predator currency. And that's what would happen. The dollar would become a predator currency. And when the dollar becomes a predator currency, I want you to think of it like this. When the dollar reaches a level that all other currencies begin to weaken to the point of contagion event, which may end up being somewhere up here above 30, 33 for the UUP. And we can come over here to the dollar index. 1 second. So in relation to the dollar, if we were to go back to daily and really try to take a look at this, the dollar right now is somewhere around 106. I don't want to invert the scale. I want to auto scale. So at this point, ladies and gentlemen, taking a look at the dollar, I'm going to try to get as much data as I can on here. Go to weekly, and you can see here we've got previous peaks up here at 119, 160. This was in 1984. If the dollar were to rally up to these levels, oh my gosh, gosh forbid, we would be looking at some real contagion events, okay? This presents a very real risk of what I'm going to call predator dollar. Okay, this becomes predator dollar. This becomes here up in this area. Try to change this a little bit red. This becomes contagion US dollar. Okay, so here's what it boils down to. We have contagion dollar, predator dollar. At this level, we're going to start to see some real contagion events come into play, and we're really only maybe a couple of weeks away from this move, if my thinking is correct. Up in this area, we're getting into real contagion events, which means that we're going to be looking at foreign markets really unwinding currency and asset values because the cost of the translation from their currency to US dollar is becoming very unsound. At this level, we're looking at predator dollar. The dollar has essentially wiped out many weaker foreign currencies, and it's now become a point where the US dollar has become the apex predator around the globe, that no other currency is safe, and this would present real risk in a globally connected market. So again, I'm going to share this with everyone along with this video. I want you to be aware that you need to stay keenly aware of what's going on in the markets. And I want you to understand that you need to come to my website here, ment.com. Join, please. It's free. My videos are free. My research is free. I have a YouTube channel. I have Twitter. I'm on TradingView. And I have a Telegram channel. You can create your account for free. I'll help you navigate this. I'll give you my opinion. You do what you want. You ultimately make your choices. All I'm trying to do is help you navigate these massive market trends. And I think the next 5 to 7 years are going to be incredible for traders and investors if you stay ahead of these big trends. Come and watch my new video. Okay, I'm going to post up my new video today. It's available on Twitter and YouTube and LinkedIn already. Come and get it. You can see what I'm talking about and be prepared for this move. The US dollar is going to do some really crazy things, and it's going to create some real big risk for the markets if we see this move up just a little bit higher. So we need to see maybe 2.5% higher in the US dollar, and then we start moving into contagion range. Beyond 125, 130 in the US dollar, and we start moving into predator phase for the US dollar. All right, that's it for now. Talk to you later.